It's over. The Swiss National Bank just pulled the trigger, without warning, without consultation, without regard for the consequences. At 3:47 a.m. Zurich time, they made a decision that shattered 40 years of monetary cooperation, a decision that broke the back of the global financial system, a decision that proves the game was always rigged and now they don't care who knows it. Ladies and gentlemen, Asian guy here. What happened in that windowless conference room in Basel this morning will be remembered as the moment the old order died. The Swiss National Bank, the most conservative, most predictable, most boring central bank on earth, just declared financial war on the rest of the world. And they did it with a single sentence in a press release that most people will never read. The decision sounds technical, mundane. The Swiss National Bank announced the immediate termination of all bilateral swap agreements with foreign central banks. They're cutting the liquidity lines. They're severing the financial arteries that have kept the global banking system alive since 2008. They're pulling the plug on the life support machine that has been keeping zombie banks breathing for 15 years. But this isn't just about liquidity swaps. This is about trust. This is about the fundamental promise that central banks will coordinate during crises to prevent systemic collapse. That promise just died. The Swiss looked at their swap partners, looked at the trillions of dollars in liabilities flowing through their system and said, "We're done. We're not subsidizing your failures anymore. We're not backstopping your banks anymore. You're on your own." The timing is devastating. This decision comes exactly as the institutional exodus we've been tracking reaches critical mass. $6 trillion has already fled the traditional banking system. Alternative clearing networks are overwhelmed with demand. Physical asset markets are experiencing unprecedented stress. And now the Swiss just cut the emergency funding lines that were keeping the whole structure from collapsing. The Swiss knew exactly what they were doing. Their decision wasn't impulsive, it wasn't emotional, it was calculated. They looked at the intelligence we've been analyzing, the same intelligence that triggered the $6 trillion exodus, and they realized something terrifying. The system is going to collapse anyway. The question isn't whether it collapses. The question is, who survives the collapse? And the Swiss just ensured they'll be among the survivors. Internal documents from the Swiss National Bank, leaked through regulatory filings, reveal the true reasoning behind their decision. They conducted stress tests on scenarios involving mass institutional withdrawals from the global banking system. The results were catastrophic. Every model showed complete systemic failure within months. The swap agreements weren't going to save the system. They were only going to drain Swiss resources trying to bail out the unsalvageable. The leaked documents contain specific calculations that explain the Swiss panic. Their models projected that continued swap line obligations would expose Switzerland to $2.4 trillion in potential liabilities if the European banking system collapsed. That's more than double Switzerland's entire GDP. The Swiss realized they were being asked to guarantee debt levels that would bankrupt their entire nation if triggered simultaneously. But the most damning revelation in the leaked documents involves coordination with other central banks. The Swiss discovered that their supposed partners had been systematically understating their exposure levels in official reports. German banks reported $400 billion in dollar funding needs while actually requiring $800 billion. French institutions claimed $300 billion in swap line dependency, while documents showed $600 billion in actual exposure. Italian banks' real funding gap was triple their disclosed requirements. The deception went deeper. The Swiss found evidence that major European institutions had been using Swiss swap facilities to obscure their true financial condition from domestic regulators. Money borrowed through Swiss lines was being relabeled as commercial funding in regulatory reports, hiding the extent of central bank dependency. The European banking system wasn't just unstable, it was fraudulently misrepresenting its stability to avoid regulatory intervention. This discovery triggered an emergency review of all Swiss international commitments. Intelligence analysts within the Swiss National Bank found similar patterns of deception across multiple jurisdictions. American regional banks had been using Swiss franc swaps to mask dollar funding shortages. Japanese institutions had been utilizing Swiss facilities to hide yen liquidity problems. The web of misrepresentation extended far beyond Europe. The Swiss also discovered that their swap partners had been actively working against Swiss interests in other forms, while publicly requesting continued Swiss support. These same institutions had been lobbying for international regulations that would specifically target Swiss banking secrecy and tax advantages. They wanted Swiss money to bail them out while simultaneously destroying Swiss competitive advantages. The hypocrisy was breathtaking. Armed with this intelligence, the Swiss made a calculated decision. They could continue subsidizing institutions that were lying to them while working to undermine them, or they could cut their losses and focus on protecting Swiss interests exclusively. The decision became obvious once the deception was exposed. The operational mechanics of the Swiss withdrawal reveal the sophistication of their preparation. This wasn't an impulsive decision announced without planning. Swiss institutions had been quietly reducing their exposure to foreign counterparties for months. Swiss banks had been requiring increased collateral from international borrowers. Swiss financial infrastructure had been systematically isolated from foreign dependencies. The Swiss even prepared alternative arrangements for legitimate international business. New bilateral agreements were negotiated with financially sound partners in Asia and the Middle East. Private settlement networks were established to maintain trade finance capabilities without central bank involvement. Direct commodity financing mechanisms were created to bypass traditional banking channels entirely. Most importantly, the Swiss coordinated their withdrawal with other institutions that shared their assessment of systemic risk. Sources within the Bank for International Settlements confirmed that the Swiss decision was preceded by private communications with central banks in Singapore, Norway, and several other financially conservative jurisdictions. The Swiss weren't acting alone. They were leading a coordinated retreat by the responsible actors from a system dominated by reckless participants. So they cut the lines. They severed the connections. They isolated themselves from the contagion that they know is coming. It's financial triage. They decided that trying to save everyone would result in everyone dying. Better to save themselves and let the others collapse than to go down with the ship trying to keep it afloat. The immediate reaction was panic. Currency markets seized up as traders realized the implications. The euro crashed as European banks lost access to Swiss franc funding. The dollar spiked as institutions scrambled for the only remaining reserve currency with functioning swap lines. But these are just the surface effects. The real damage is happening in the plumbing of the global financial system. European banks are facing immediate liquidity crises. They used Swiss funding lines to manage their dollar exposure, their commodity financing, their cross-border settlement obligations. Those lines just disappeared. Overnight, hundreds of billions in banking operations lost their funding source. Banks that were functioning normally yesterday are facing potential insolvency today. The Federal Reserve tried to contain the damage. Emergency swap line extensions were offered to European central banks to replace the Swiss funding. But there's a problem. The Fed's balance sheet is already stretched to the breaking point from previous interventions. They don't have the capacity to replace Swiss funding without triggering their own crisis. They're trying to bail out a sinking ship with a bucket that has holes in the bottom. The Bank of England activated emergency protocols to provide sterling liquidity to UK banks affected by the Swiss decision. But sterling isn't dollars. Sterling isn't euros. The currency mismatches created by the Swiss withdrawal can't be solved by printing more pounds. The Bank of England is trying to solve a structural problem with a monetary solution that doesn't address the underlying issue. The European Central Bank convened emergency sessions to coordinate a response, but coordination requires cooperation, and cooperation requires trust. The Swiss just demonstrated that trust is dead. If the most reliable, most conservative central bank in the world can unilaterally terminate critical agreements without warning, what does that say about the reliability of any central bank promise? The breakdown is spreading beyond Europe. The Bank of Japan discovered that their dollar funding operations relied heavily on Swiss intermediation. Without Swiss participation, Japanese banks lost access to critical funding markets. The Reserve Bank of Australia found that their commodity financing structures depended on Swiss backing. The Bank of Canada realized their cross-border payment systems used Swiss infrastructure that is no longer available. This is the cascade effect we've been warning about. The Swiss decision wasn't just about Swiss policy, it was about revealing the hidden dependencies that connected the entire global system. Every central bank thought they understood their exposure. Every financial institution thought they knew their risks. The Swiss just proved they were all wrong. But the Swiss decision reveals something even more significant than hidden dependencies. It reveals that central bank coordination, the foundation of global financial stability since Bretton Woods, is breaking down. Not gradually, not predictably, suddenly and completely. The Swiss just sent a message to every other central bank. We're not playing by the old rules anymore. The message is being received. Sources within the Bank for International Settlements confirm that other central banks are reviewing their own swap agreements, their own exposure to foreign financial institutions, their own vulnerability to partner decisions. The Swiss decision is being interpreted not as an isolated event, but as the first move in a broader retreat from global coordination. The Norges Bank quietly suspended new swap commitments pending strategic review. The Swedish Riksbank announced temporary limitations on foreign currency operations. The Singapore Monetary Authority implemented enhanced due diligence requirements for international banking relationships. The dominoes are falling. The coordination that prevented the 2008 crisis from becoming a complete systemic collapse is disintegrating. This breakdown explains why the institutional exodus has accelerated beyond all projections. The smart money didn't just see the Swiss decision coming, they saw what it represented. They understood that central bank cooperation, the ultimate backstop for the global financial system, was ending. They realized that the safety nets they relied on were being cut by the very institutions that created them. The Swiss decision also explains the desperate attempts by other authorities to prevent further institutional withdrawals. If central banks are retreating from coordination, if swap lines are being terminated, if liquidity support is disappearing, then traditional financial institutions become unviable. The only rational response is to exit the system before it collapses completely. But the most terrifying aspect of the Swiss decision is its irreversibility. Swap agreements can be restored, liquidity facilities can be reactivated, trust, once broken, cannot be repaired. The Swiss just demonstrated that even the most conservative institutions will prioritize their own survival over systemic stability when forced to choose. That demonstration has changed the calculation for every other participant in the system. The implications for the CBDC timeline are immediate. If traditional central bank coordination is breaking down, if existing monetary infrastructure is failing, then the pressure to implement alternative systems becomes overwhelming. The Swiss decision didn't just break the old system, it created urgency for implementing the new system that we know is waiting in the wings. Digital currency implementation becomes inevitable when analog currency systems are collapsing. The Swiss decision just accelerated that timeline from years to months. When cooperation fails, control becomes the only alternative. When coordination breaks down, centralization becomes the solution. The Swiss didn't just terminate swap agreements, they triggered the final phase of monetary system transformation. The corporate response is already visible. Companies that relied on Swiss banking relationships are scrambling to establish alternative arrangements. Supply chains that depended on Swiss trade finance are experiencing immediate disruptions. International business operations that used Swiss financial infrastructure are facing operational paralysis. Apple discovered that their international cash management relied heavily on Swiss banking systems that are no longer accessible. Microsoft found that their European operations use Swiss-backed payment processing that has been discontinued. Amazon realized that their global logistics financing depended on Swiss credit facilities that have been terminated. The technology giants that seemed immune to financial disruption are suddenly facing operational crises. The energy sector is experiencing immediate impact. Oil trading operations that used Swiss franc funding found their credit lines severed without warning. Natural gas transactions that relied on Swiss settlement systems are facing clearing failures. Renewable energy projects financed through Swiss institutions are discovering their funding has disappeared overnight. But the most significant impact is on the precious metals market. Switzerland has been the hub of global precious metals trading for decades. Swiss refineries process the majority of world gold and silver production. Swiss vaults store the strategic reserves of multiple nations. The Swiss decision just created uncertainty about the continued availability of these critical services. Gold and silver prices exploded as markets realized that Swiss processing and storage might become unavailable to foreign institutions. Physical metal demand spiked as traders rushed to secure inventory before Swiss facilities potentially closed to international business. The premium for physical delivery reached historic levels as the market priced in the possibility of supply chain disruption from the world's primary precious metals hub. This connects directly to the physical asset trend we've been tracking. The institutional exodus from paper assets into physical assets just became urgent. If Swiss financial infrastructure is being withdrawn from international markets, if Swiss processing capacity might become unavailable, then securing physical assets immediately becomes critical for any institution with significant exposure. The Chinese response was swift and decisive. Within hours of the Swiss announcement, Beijing activated emergency protocols to redirect precious metals flows through domestic channels. New bilateral agreements were signed with producing nations to bypass Swiss intermediation. Alternative refining capacity was brought online to replace Swiss processing. The Chinese saw opportunity in Swiss withdrawal and moved immediately to fill the vacuum. Russia followed similar strategies. Sanctions had already limited their access to Swiss financial services, so the formal termination had minimal direct impact. But they recognized the strategic opportunity created by Swiss withdrawal from global markets. Russian financial institutions, previously excluded from many international arrangements, suddenly found themselves in demand as alternatives to Swiss services. The geopolitical implications are staggering. Swiss neutrality, Swiss reliability, Swiss stability have been cornerstones of international finance for generations. That foundation just cracked. If the Swiss are withdrawing from global coordination, if Swiss institutions are prioritizing domestic over international obligations, then the entire architecture of neutral international finance is collapsing. This collapse is accelerating the multipolar transition that governments have been trying to manage gradually. When Swiss institutions withdraw from international markets, those markets don't disappear. They relocate, they restructure. They find new homes in jurisdictions that are willing to provide the services that Switzerland is abandoning. The Federal Reserve is facing an impossible choice. They can try to replace Swiss capacity by expanding their own international operations, risking overextension and domestic backlash, or they can accept the reduction in global dollar-based financial services. accelerating the decline of dollar dominance. Either choice weakens their position. The Swiss decision put them in a no-win scenario. The European Central Bank faces similar constraints. European financial institutions depended heavily on Swiss services for international operations. Those services are disappearing. European alternatives don't have the capacity or the credibility to replace Swiss infrastructure immediately. European finance is being forced to shrink or find non-European partners. The timeline for systemic transformation just compressed dramatically. Changes that were projected to occur over years are now happening in weeks. The Swiss decision didn't just break existing arrangements. It created vacuum effects that are sucking alternative systems into existence at unprecedented speed. Alternative clearing networks that were planned for gradual implementation are being accelerated to emergency deployment. Digital currency systems that were scheduled for careful testing are being rushed into operational status. Physical asset custody arrangements that were being developed for future use are becoming immediately necessary. This is the moment the old financial order died. Not with hyperinflation, not with currency collapse, not with bank failures, but with a single central bank decision to stop cooperating with a system that was already failing. The Swiss didn't break the system. They just admitted it was already broken and refused to pretend otherwise. The game is over, not because someone lost, but because the most conservative player just left the table. And when the most conservative player abandons the game, it proves the game is no longer worth playing. The Swiss National Bank just sent that message to the world. The question now is, who else will follow them out the door?